Hey everybody, Mo here. Today we're going to take a look at Curaleaf's third quarter earnings results, which they released yesterday, November 8th. Sorry for getting this video out late. By the time I got off work yesterday and then listened to the earnings call and digested all this information, it was already pretty late. So we're going to cover this today. And I think this is all we're going to cover today. And any other items I have to talk about we'll save for a separate video. So to summarize the quarter, I think Curaleaf Chairman Boris Jordan's statement does it pretty well here. It says, during the third quarter, we delivered record revenue of $317 million, representing 2% sequential and 74% year-over-year growth. We also generated $52 million of positive operating cash flow. While we faced some transient headwinds during the quarter, we continued to execute well against our strategic initiatives, prioritizing growth and gaining market share. As a result, we remain on track to achieve our $1.2 to $1.3 billion annual revenue guidance, albeit at the lower end of the range, representing growth of over 90%. Strategic M&A remains a key pillar of our growth plan. We closed the Los Sueños Farms acquisition in October, and today announced another highly strategic deal to acquire Tryke Companies, a vertically integrated MSO which bolsters our leadership position in Nevada, Arizona, and Utah, and will be immediately accretive to our margins and cash flow. So we'll dive deeper into the financial results here in just a moment, but that hits the highlights. Third quarter revenue was $317 million, up 2% on the quarter and 74% on the year. If you're a Mary Jane Markets listener, you know the transient headwinds Boris is referring to here. We've talked about these in depth, and he also touched upon them in the earnings call, namely shift in consumer behavior after the pandemic, pricing pressures, some markets not opening as soon as we thought they would. Full year revenue is likely going to be around $1.2 billion. And then in terms of the acquisitions, we've talked about the Los Sueños Farms acquisition on this show before, but the Tryke acquisition is something new that they just announced yesterday. We'll take a look at that in a couple of minutes here as well. I want to touch on some of the operating highlights as well, some of which we've talked about in previous episodes. So they added 2 new dispensaries, one in New Jersey, one in Maine, and then they added a couple more in Colorado with the Los Sueños, and then it looks like they're adding 6 more with the Tryke acquisition, 4 in Nevada, 2 in Arizona. But to get a better idea of the operational progress, I do recommend listening to the earnings call. That information is in the release here, and you can still listen to a replay of it. Maybe if there's interest in the future, we can do a live stream of that here and dissect that together. But let's move on to the financial results. I'm going to be jumping back and forth between a few screens here. I hope that's okay and everything is readable on screen. So on the right here is the release. On the left here is my own model. And then we'll also pop open the financial statements that they submitted to SEDAR and take a look at those. All right, so let's start off with revenue. Oh, I should also preface that in my model on the left here, I've made adjustments where I feel is appropriate to get a better sense of the business and get rid of some of the accounting nonsense. So I'll point that out as I go through it, but you'll notice what you see on the left doesn't always match what's on the right. So in my model, I exclude management fee income, which drops revenue to $316.5 million. It does bring sequential growth down slightly to 1.63%. And my reason for doing so is simple. It's not part of the core business. And when I'm comparing companies, I want to compare apples to apples. And I'm comfortable doing this because this is peanuts compared to the other business segments, and it's been drastically decreasing over the years. But the highlight here to take away is the growth of 1.63%, which sticks out like a sore thumb compared to the growth in prior quarters. Hopefully you can see that really clearly on your screen here. COGS of $172 million were 54.4% of revenue, which is a 4-point jump from what we saw in the first half of the year. And that's explained by a one-time loss on inventory related to the Eureka, California facility divestiture, lower revenue growth in certain Northeast markets, probably New York and New Jersey as we've talked about in this show, and the write-down of certain other inventory. So I think what's going on here is Curaleaf is taking a bigger hit on depreciation of PP&E. That's property, plant, and equipment. So part of the cost to produce something is depreciation on the equipment that's used in manufacturing. So if the company depreciates a certain piece of equipment over 10 years on a straight line basis, meaning an equal amount of depreciation every year, and then you divide that amount up amongst the units produced from that equipment and add that on as a cost to each of the units, you're effectively spreading out that depreciation cost as an input or a cog to produce that good. So if you produce a lot of them over the quarter, that depreciation cost gets spread out over a lot of units. But if that equipment is sort of just sitting there most of the time and you're not producing much, consider, for example, New Jersey that we talked about last week. There's a state that Curaleaf has the capacity to service the recreational market, but that market isn't yet online. And we heard Curaleaf's Northeast president say that only about 1/3 of their capacity is being used to service the current medicinal market in the state. So they're having to basically eat the costs of that other 2/3. And the per unit depreciation costs are higher than what they would be if they were operating at full capacity there. Hopefully that makes sense. And since COGS have jumped up, their gross profit margin has dropped 6.57% to 45.6% from their 49% range. The other thing I've done here differently than the accountants is exclude any fair value changes to their biological assets. So this is just something they have to do for the accountants. It doesn't properly reflect their operating income during the period, and any net changes to their assets are reflected on the balance sheet, but you can see just how big of a difference this makes here. It artificially boosts gross profit here by $40 million. But moving along down the income statement, SG&A and depreciation and amortization I include. I also exclude stock-based compensation. That's taken care of in the statement of cash flows. So that brings our adjusted EBITDA to 42.5, operating income to 14.8. So that has dropped quite a bit from previous quarters. Along with that increase in COGS margin, we're seeing some of that due to the increase in SG&A. Either I didn't catch that on the call or it wasn't explained, but I'm deducing that it's due to some of those additional dispensaries that have come online, some other headcount increases in states where they expected to be operational but aren't yet due to some of those headwinds we mentioned. But if we keep going here, netting out other expenses, our pre-tax income comes in at $6.7 million. Then they set aside $60.3 million for taxes. That's a bit more than what we've seen in previous quarters at 19%. And that's despite revenues staying about flat and gross profit decreasing by $10 million. So you guys probably know because of the 280E tax law that this full $144 million of gross profit is taxed. So that drops their earnings before interest payments to a loss of $53.6 million. And then the interest payment was $25 million, placing them at a net loss for the quarter at $78.8 million. So that's more than $50 million more than previous quarters. And I don't want to repeat myself, but you can go back up this list and see where that's coming from. You probably also notice an almost $22 million difference between Curaleaf's reported net income and my adjusted number. And that's really just coming from their fair value adjustments on their assets. So all in all, I think the quarter fell short of everyone's expectations. Being a growth company, we expect to see higher costs quarter over quarter. But when that growth isn't there due to the headwinds, we get understandably disappointing results. There were a couple of other things I wanted to point out from the earnings call. Just some things that Chairman Boris Jordan and CEO Joe Byrne and CFO Ron John pointed out or touched on. One of those things being the transient headwinds we're facing right now in the sector. That was talked about a couple of times. Again, if you're a Mary Jane Markets listener, that shouldn't have come as a surprise to you. But they believe, as do I, that those forces are transient. And as we get out of this pandemic or post-pandemic lifestyle, some of those recreational markets actually start to come online rather than just being rec in name only. Maybe one of the now 4 bills at the federal level will actually materialize into something concrete. Those winds will change. And overall, they were still bullish on the sector. A couple things in terms of market share and footprint. They're claiming to have doubled their market share in Florida and expect to reach 60 dispensaries by the end of 2022. And the focus in the state over the last quarter has really been on cultivation and products. Going back to dispensaries, they expect another 6 to come online in 2021, and that's going to be across Arizona, Pennsylvania, Florida. In cultivation, they tripled their capacity in New Jersey, and they have future plans to double it. In New York, they want to add another 100,000 square feet of canopy next year. One other interesting tidbit was about their Los Sueños acquisition in Colorado. So they say that the plan for that facility is to service the entire US market when interstate comes online. So I thought that was interesting. First time I heard that. That is the largest grow up in Colorado, and I know much of that is outdoors. So kind of interesting to have such big plans for that, given how new that acquisition is. Another thing was the CFO saying that they hired financial advisors to help reduce their debt. So we'll keep an eye out for news on that. Another thing I tried to find more information on was they said there was a fire incident at their main cultivation facility over the quarter, but I couldn't find any information on that. So if you see anything out there, let me know. I guess lastly, just to wrap up, since we are 3 quarters into the year and they gave us full year guidance, we can sort of get an idea of what Q4 and the year is going to look like. These are really rough and I'm not putting any weight into them. But if we take full year guidance of 1.2 billion, we can expect Q4 to be pretty flat as well. COGS will probably stay on the higher end. I don't foresee those headwinds changing in Q4. It does mean we take a little bit of a hit again in gross margin. SG&A costs, though, are something that are controllable, and I'm assuming they can scale back in some of those states like in the Northeast, where now they don't expect to ramp up as quickly. EBITDA margin, Chairman Jordan said, was going to be around 25% for the full year, so I'm probably too low here. We'll have to see how they achieve that on flat revenues. But again, we should expect a net loss for next quarter and the year, which is perfectly fine for a younger, high-growth company. At this stage of the game, they should really be focusing on growth and not profitability, especially since they can readily raise money. But yeah, expect flat revenues, net loss. Not foreseeing a whole lot of changes from that, with only a few more dispensaries coming online since that acquisition did close yesterday. But that Tryke acquisition isn't expected to close until second half of next year, which, speaking of, we should talk about that. So Curaleaf has acquired Tryke companies for $286 million in cash and stock. Tryke is a privately held, vertically integrated MSO, and the deal is expected to close in the second half of 2022. They do give us a few details on the transaction. So of the 286, 40 million will be paid on close in cash, and then another 75 million in cash paid in equal installments on the first, second, and third anniversaries of close. So that adds up to 115 million. And then on the stock side, they say that 17 million subordinate voting shares will be paid in 3 equal installments again on the first, second, and third anniversaries of close. What's interesting here is that that's not pegged at a dollar figure. At least from the way that this is written, this seems like it's just a number of shares that's going to be delivered. But 17 million is about 2.5% of the current share count. So it's hard to say what the actual cash value of that is going to be between 2023 and 2025. But if you take that 17 million times today's share price and add that to the 115 million in cash, and that gets you close to the total 286 million. One other thing I forgot to mention was this incremental earnout that's based on hitting certain EBITDA targets. So we've seen this strategy play out across the industry. These earnouts incentivize management there to keep performing at a high level and not just check out after the transaction closes. I mentioned that Tryke operates in Arizona, Nevada, and Utah, and there's more information on the company in this press release. I'm not going to go into it here just for the sake of time, but if you're interested, go check it out. Maybe this is something we'll talk about more in a future episode, but I want to wrap this one up. Hopefully that was a satisfactory recap for my first time. Thank you so much for listening. If you want to reach out to me, the best place to do that is on Twitter. My handle is @MJMarkets. If you know of other investors that would benefit from my content, please share this out. And hopefully I'll talk to you all on Wednesday for GTI's earnings recap. Thank you.